Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent move lower since mid-August has mainly been captured with a bear channel, currently 1161 to 1256. However, the influence of the, well, let's be frank here, optimized February to October head and shoulders top neckline, currently at 1256, has had a tempering effect on the move lower, even though the neckline itself is bearish. It is just that the neckline is of a shallower bearish angle than the bear channel, and that is what is tempering the move lower, such that I have drawn a newer bear channel, currently 1182, 1278. Even this newer mid-September base bear channel is, in my eyes, still lacking confidence, as the optimized neckline is still shallower still. Nevertheless, I am not letting go of the former, more steeply angled bear channel, in indicating the direction and size of plus the angle of the move down, at least not just yet. To add more to the mix, we yesterday had a schizophrenic pattern, a combined key reversal up that was also an indecisive spinning top, all just under the neckline and original upper bear channel line of the original bear channel. Anyway, 2 weeks ago we reached target X1 on the downside at about 1201. This was the secondary target for the mid-June to mid-August ascending triangle pattern. In many ways, you just looked at that pattern, then you could say that the move lower was done. However, we still have target X2 a little lower down. This is the target for the second related pattern. This is the really messy looking bearish halfway hesitation from early to mid-June. This period made the left flagpole, and then afterwards, well, it just became a real mess. I suspect the mess was in part, probably a large part, due to the clash with the previously mentioned ascending triangle pattern. Anyway, I'm minded to remove this target completely now and just have targets X3 and X4 below. Wait, what did I hear you say? You can see target X3, but what about target X4? Well, target X3 in the 1083 area is the primary target for the previously mentioned optimized February to October head and shoulders top. Meanwhile, target X4 is absent from the daily chart because it is the secondary target for this same head and shoulders top and is down below in the 904 area. Now, before you start going off, I know that these two are a big ask, and I would rather point them out now than stay silent. That is what the current situation looks like right now. Chicago soybean meal. I wrote some 15 weeks ago now and have repeated it ever since, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. What I wanted to emphasize back then and every time since, including now, is that everything since May has been in the shadow of that singularly bearish pattern. With this in mind, it brings into perspective the breakdown in June through the long moving average, currently at 381.60, and a further drop to the lower time, currently 277.80, of the bearish 2021 Andrews pitchfork. The subsequent bounce back up in early July only ended the market going sideways through July and August, and also running along the underside of the middle time, currently at 324.10. As part of this whole action, markets moves also created a lower trend line, currently at 344.20, thus drawing a descending triangle pattern over July and August period. In late August, prices punched down through the lower trend line of the descending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag seen during May and June. However, when prices dropped down there some 8 weeks ago now, the market must have felt it was also too far away from the comfort and security of the middle time, hence prices moved back up towards it. This is something I'd like you to remember, as it may be coming up again. Anyway, Thursday 3 weeks ago, the market felt secure enough to plunge lower and punch down through all of the following: the middle time, the old target X, the low of early September at 332.5, and made new lows and low closes not seen since September last year. On Monday 3 weeks ago, prices finally reached down to target X1, the initial target for the descending triangle in the 326.10 area. 2 weeks ago, the market made a new recent low and grazed the area around the secondary target X2 in the 306.80 area. I have in the past pointed out the caveat, and I do so now, that secondary targets are far harder to achieve than the initial ones. Anyway, since then the market seemingly craved security once again and moved up last week and this week to fondle the middle time once again. Interestingly, yesterday was a significant close up over the middle time. It was done with a bullish pattern. Plus today, well, today we've so far spent the whole time over the middle time. This is the first time since mid-May, so it has some significance, and maybe the first time we've seen a real attempt higher, though at the moment today's pattern still looks like an indecisive doji cross, though it's moving maybe towards a hammer or possibly a lucky dragonfly doji. Anyway, one final point I'd like to once again recognize, and that's the wonderful job the bearish Andrews pitchfork for 2021, originally drawn back in May, has done in its task of channeling the market lower. It has been useful and valid up until this very day, and still seems likely to be so despite today. This bearish Andrews pitchfork is the key to the market here. When it finally gets busted or adjusted to a bearish shift pitchfork or some other pattern, only then we can look for new ideas. But until then, the bearish incentive is still run and ruled in this market by this same simple bearish Andrews pitchfork. Chicago soybean oil. For months now I've highlighted the rather lopsided diamond pattern seen back in May to July. Looking again today, I still find it being a very influential pattern, though with other smaller patterns, in most cases competing patterns. A few words again on this diamond pattern. Diamond patterns can be tops, bottoms or continuations. In this particular case it is, or rather was, a topping pattern. Back in late July, the market broke down through the lower trend line, but did not immediately follow through lower. Prices finally dropped in late July and early August, but were halted for a while by the medium moving average, currently at 16.91. By the middle of August, prices had overcome this obstacle and continued their journey lower through the congestion zone between 57.64 to 59.44, which you can see as a striped band across the middle of the daily chart, and punching through the lower trend line, currently 51.40 of the July to date descending wedge pattern. The market tried exploiting this breach, but all that was managed was an additional, if short, bear channel over mid-August till late September. 5 weeks ago, the market met a fresh pair of obstacles on their way down, which they couldn't overcome. They were the rising long moving average, currently 57.52, and the 50% Fibonacci line for the whole of 2021 so far at 55.43. Nevertheless, the market tried hard to overcome these, managing 2 consecutive closes below the 50% Fibonacci line, if only just on the second day, but there were no closes below the long moving average. In disappointment, prices moved back up again within a new small bear channel, then the descending wedge pattern, and then gained momentum moving up over the previously mentioned congestion zone between 57.64 to 59.44. In this last process, the market punched up and out of the descending wedge pattern, as well as over the flatlining short-medium moving average, currently at 59.43, and over the slowly declining medium moving average, currently 60.91. However, the move up over the medium moving average was and is not easy. 3 weeks ago, prices peaked over and then immediately dropped down again into the striped congestion zone. Last week, the market tried again, this time managing a pipe top midweek, before this week dropping down once again below the medium moving average. I initially drew a prospective and opportunistic bullish Andrews pitchfork for this action, but it broke down below it this week, and I now instead have a prospective and opportunistic October-based bull channel as an avenue the market might like to try higher along. That's currently between 60.39 and 65.25. This is still a nascent idea right now, so I'm happy to discard and retire it if it doesn't work. Now, going back a bit to the original descending wedge pattern from July to September, I placed initial target X2 in the 6680 area. That's for this pattern. Now I knew when I placed it, and again today, that this was and is a big ask. But I did point out repeatedly that unless this was a false break higher, then this is what the potential target would be topside. I also gave two targets below in the past. Initial target X in the 5590 area and a secondary target X1 in the 5380 area. These were the targets for the original diamond top pattern back in May to July. Now target X has already been reached, and target X1, the always harder secondary target, came close enough in mid-September that upon reflection I've decided to retire them both after today. That is what it all looks like right now. A lot of support below and an opportunity above, if the market is so minded. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.